Imagine this for a second. Silver prices are crashing fast, red candles everywhere. News anchors are panicking, Twitter is screaming, buy the dip. YouTube thumbnails are full of shocked faces, and retail investors are rushing in, convinced this is the opportunity of a lifetime. But here's the uncomfortable truth most people don't want to hear. Almost every time silver crashes, retail investors don't win. They lose, not because they're stupid, not because they're unlucky, but because the game is designed in a way they don't fully understand. And once you see how this game really works, you'll never look at silver crashes the same way again. In today's video, we're breaking down exactly why retail investors consistently lose money during silver crashes, using real historical behavior, real market mechanics, and real psychology. This isn't theory. This is a case study that's played out again and again. And if you're serious about protecting your capital, or even profiting in the future, this is something you need to understand deeply. Before we go any further, take a second to like this video and subscribe to the channel. On Empire Economics, we break down markets the way institutions actually see them, not the way social media hype wants you to believe. If you want smarter, calmer, and more strategic market thinking, you're in the right place. Now, let's rewind and talk about why silver attracts retail investors in the first place. Silver feels different from stocks. It feels real. It's tangible. You can hold it in your hand. For many people, silver represents safety, honesty, and protection from inflation, government debt, and financial chaos. So when prices fall sharply, retail investors don't see danger. They see a discount. They see a once-in-a-decade opportunity. They think, silver is money. It can't go to zero. This is my chance. And that belief is exactly where the problem starts. Because silver doesn't move like a normal asset. It doesn't behave like a tech stock or a consumer brand. Silver is a thin, highly leveraged market dominated by institutions, banks, futures traders, and industrial hedgers. Retail investors are not the main players. They are the last ones to react, and usually the ones providing liquidity at the worst possible moment. When silver crashes, it almost never crashes because demand disappeared overnight. It crashes because leverage is being unwound. Futures contracts get liquidated, margin calls force selling. Large players reduce exposure to manage risk, and this selling happens fast, aggressive, and without emotion. Institutions don't panic, they execute. Retail investors, on the other hand, experience silver crashes very differently. They feel shock, fear, confusion, and then hope. They zoom out on the chart and tell themselves stories. Silver always comes back. This drop is manipulated. This is a gift. And emotionally, that makes sense. Psychologically, it feels logical, but market logic doesn't care about feelings. Here's where the trap really closes. During a crash, volatility explodes. Silver can drop 5, 8, even 10% in a single session. Retail investors who buy early in the crash think they're smart. They believe they caught the bottom. But silver rarely bottoms in one move. It stair-steps lower. Each bounce looks convincing. Each bounce feels like the reversal. And each bounce sucks in more retail buyers. Meanwhile, institutions are doing the opposite. They're either already out or they're using those bounces to unload remaining positions at better prices. This is something most retail investors never consider. When price bounces during a crash, it's not always strength. Often, it's distribution. Another reason retail investors lose is time horizon mismatch. Retail buyers often believe silver is a long-term hold, but they buy it using short-term emotional capital. They say they'll hold for years, but they check the price every hour. Every red day feels painful. Every bounce creates false hope. Over time, stress builds, and eventually, many sell at exactly the wrong moment, not because they were wrong fundamentally, but because they couldn't emotionally survive the volatility. Now, let's talk about leverage, because this is where things get brutal. Many retail traders don't just buy physical silver. They trade ETFs, options, or futures without fully understanding how leverage amplifies losses. In silver crashes, leverage doesn't forgive mistakes. A 10% drop in spot silver can wipe out a much larger percentage of leveraged positions. Margin calls force selling at the worst possible price. And forced selling is not a choice, it's automatic. Institutions know this. They know where leverage sits in the market. They know where stops are clustered. They know how panic spreads. So when price starts falling, momentum feeds on itself. Retail investors aren't losing because someone hates them. They're losing because they're structurally weaker players in a fast, leveraged market. Another critical mistake retail investors make during silver crashes is confusing narrative with timing. The long-term story for silver might be bullish. Inflation, currency debasement, industrial demand, green energy. All of that may be true, but markets don't move in straight lines, and being early is often the same as being wrong. You can be right about the story and still lose money if your timing is off. Silver crashes punish early buyers relentlessly. Price can stay lower far longer than retail investors expect. Capital gets tied up, opportunity cost builds. And while retail money is stuck hoping for a rebound, institutions move on to other opportunities. There's also a psychological element that doesn't get talked about enough. Silver attracts people who already distrust the financial system. That means when price falls, instead of questioning their entry, they often double down on belief. They blame manipulation, banks, or governments. Again, sometimes manipulation exists, but blaming manipulation doesn't fix bad positioning. The market doesn't reward belief, it rewards execution. And this is where many retail investors turn silver investing into an identity, not a strategy. Once it becomes personal, it becomes dangerous. Every drop feels like an attack. Every critic feels like an enemy. And that emotional attachment makes rational decision-making almost impossible. At Empire Economics, we've studied silver cycles closely, and one pattern keeps repeating. Retail investors enter during high volatility, high emotion, and high narrative intensity. Institutions exit quietly before the chaos, or they step back in only after volatility collapses and weak hands are gone. The difference isn't intelligence, it's patience, capital structure, and emotional control. Now here's the key question you should be asking yourself. If retail investors keep losing during silver crashes, where does the money actually go? Who benefits from this pain? And more importantly, how can you avoid becoming part of that statistic the next time silver enters a sharp downturn? That's exactly what we're going to break down next. We'll look at what institutions wait for, what signals actually matter during silver crashes, and how smart money approaches these moments very differently from the crowd. But before we get there, take a moment and think about your own experience with silver or any volatile market. Have you ever bought a dip that kept dipping? Have you ever felt confident one week and stressed the next? If yes, you're not alone. This isn't about blame. It's about learning how the game really works. In the next part, we're going deeper into the case study, exposing the exact phases of a silver crash, and why retail investors almost always enter at the worst phase possible. Now let's break down what actually happens during a silver crash, step by step, because once you understand the phases, you'll clearly see why retail investors almost always step in at the worst possible time. The first phase is what looks like a normal pullback. Prices start slipping, maybe 2 or 3%, nothing dramatic. Analysts on TV call it healthy consolidation. Retail investors feel calm here. Some even feel proud for waiting. Institutions are already alert at this stage. They're watching volume, positioning, and leverage very closely. This is where smart money starts reducing risk quietly without making noise. Then comes phase 2, where selling accelerates. A key technical level breaks, stop losses trigger, headlines suddenly change tone. Words like concern, pressure, and uncertainty start appearing. This is where retail investors begin paying attention. Many still don't buy, but the idea of a good entry starts forming in their minds. Phase 3 is where the real damage begins. Volatility explodes. Silver drops hard in a short period of time. 5%, 7%, sometimes more. Social media lights up. Influencers post charts with arrows pointing up, saying this is a historic buying opportunity. Retail investors rush in here. This is where most dip buying happens. Emotionally, it feels like courage. In reality, it's impatience, but institutions see something very different. They see forced selling that hasn't finished yet. They see leverage still in the system. They know that one sharp drop usually isn't enough to clean out weak hands, so they wait. Then comes phase 4, the most dangerous phase for retail investors. The relief bounce. Price jumps a little, maybe 2 or 3% up. It feels like confirmation. Retail buyers feel smart. They post online saying, "Told you so." This is where confidence peaks, but under the surface, nothing has changed. Volume is weak, volatility is still high. Institutions often use this bounce to sell more, not buy. After that, silver rolls over again. This second leg down is where pain becomes real. Early dip buyers are now in loss, late buyers panic, stop losses trigger again, margin calls accelerate. This is where hope starts turning into stress. Retail investors don't add anymore, they freeze. Then comes the worst part, capitulation. This is when people finally give up. They sell not because of logic, but because of emotional exhaustion. They just want the pain to stop. Ironically, this is usually much closer to the real bottom. And this is where institutions slowly step back in, quietly, patiently, when volatility drops and selling pressure fades. This cycle is why retail investors lose. Not because silver is bad, but because they buy during maximum emotion and sell during maximum pain. Another major reason retail investors struggle is misunderstanding what cheap actually means. A silver price can look cheap compared to last month, last year, or even last decade. But markets don't care about past prices. They care about current positioning. If too many people are already bullish, price can still fall. Cheap is not about price. It's about sentiment and positioning. Retail investors also underestimate how long silver can stay depressed. After crashes, silver doesn't always bounce back quickly. Sometimes it moves sideways for months, even years. During that time, interest fades. YouTube videos stop. Influencers disappear. Retail investors get bored or frustrated. capital stays locked. Meanwhile, institutions wait for the next cycle. There's also a big difference between physical silver buyers and paper silver traders. Physical buyers often believe crashes don't matter because they're holding long term. But even then, crashes affect psychology, they affect confidence. And many physical buyers still buy emotionally, not strategically, often loading up heavily during crashes without considering cash flow, storage, or opportunity cost. Paper traders have it even worse. ETFs can track price, but they don't protect you from volatility. Options decay. Futures magnify losses. Silver is not forgiving to traders who don't respect risk management. So how do institutions approach silver crashes differently? First, they don't rush. They don't try to catch falling knives. They wait for volatility to compress. They wait for sentiment to flip from excitement to boredom. They wait until nobody is talking about silver anymore. That's when risk is lowest. Second, they scale in slowly, not all at once, not emotionally. They assume price could still go lower. Retail investors usually do the opposite. They go all in too early, driven by fear of missing out. Third, institutions separate narrative from execution. They might believe in silver long term, but they won't buy just because they believe. They wait for structure, confirmation, and favorable risk reward. This is the biggest lesson retail investors can learn. Markets don't reward conviction. They reward patience. If you're watching this and thinking, so should I never buy silver during crashes? That's not the point. The point is understanding timing, sizing, and psychology. Crashes are not opportunities by default. They become opportunities only after excess emotion and leverage are removed. At Empire Economics, we always emphasize one thing. Surviving the market is more important than being right. You can't profit if you're forced out early. You can't win if emotions control your decisions. So next time silver crashes, don't ask, how low can it go? Ask, who is being forced to sell? Ask, is volatility calming down or speeding up? Ask, is everyone still excited or has interest disappeared? Those questions matter far more than any price target. As we wrap this up, remember this. Retail investors don't lose during silver crashes because they lack information. They lose because they react emotionally in a market designed to punish emotional behavior. Once you understand that, you already have an edge. If this video helped you see silver crashes differently, let us know in the comments. Have you ever bought silver during a crash? What was your experience? Your comment helps the channel, and it helps other viewers learn from real stories. And if you think this video can help someone avoid costly mistakes, share it with them. Markets are hard enough already. No reason to learn everything the painful way. Thanks for watching Empire Economics. Stay patient, stay disciplined, and we'll see you in the next one.